Hello and welcome to Ravlic at Large. My name is Tom Ravlic. Thank you so much for joining me for this particular episode. And also thank you to everyone who's either subscribed, provided feedback, and also told me that making things simply made for kids deactivates comments on the videos. So you should be able to comment on this one when I put it up, I promise. Now, my guest today is somebody who will be known to quite a few of you. He appears on various television networks and talks about matters related to the economy and the investment markets. Of course, it's the Motley Fool's Scott Phillips. He's their chief investment officer. Now, one of the things I do want to stress is we're going to be talking about things that are long-term and short-term and how you need to treat that from the point of view of looking at what you do with your life more generally, but also in terms of investment, and we'll touch on policy as well. The important thing being, the question you need to be able to answer is, do I need to do something with a batch of shares or other things that I'm dealing with in my life now, or should I wait longer and allow things to grow and develop over time? We'll try and cover that off for you in the next little while with Scott. And let me bring Scott into the screen. Scott, thank you for joining me. Can you tell people what the Motley Fool is before we go into what I've promised people will talk about?
G'day, Tom. Thanks for having me, and g'day, viewers. Mate, look, the Motley Fool, this is not an ad, right? Like, we're on here to talk about different things, but we provide individual general investment advice. And quickly, while I do that, I will say, anything I do say today is general advice only. Now, we're not providing it as advice, but it's important that we say to people, whatever I say, please consider in your personal circumstances, just to keep us clear of the legal eagles. It's appropriate and important. So I'll throw that up front. Mate, we help Australians invest better, hopefully. If we're doing our job, we are educating, we are providing stock recommendations, we are talking about investing, the community, the economy, the way that we take our, hopefully, savings from what we don't spend every week, month, or year, and that's hard these days, and to make the most of it. We generally focus on shares. That's my personal view. That's probably the best asset class going forward, in my opinion. It's only my opinion. I can't guarantee anything. But yeah, that's what we do. We're a team of about 15, 16 people in Australia. There's a few hundred in the US. We're from the US originally, 1993 over there. 2011 here. I've been with the company since day one, actually. My first article was published in March 2011. The business opened its doors on January 1, and I've been here ever since.
Where were you before you joined the Motley Fool?
I've had a long and probably boring career in business, actually. So I worked for FMCG, fast-moving consumer goods companies. Worked for Woolies, and then I worked for a whole lot of suppliers, Heinz and Blackmores and Diageo, the alcohol company. Worked for 20th Century Fox and a couple others besides. So that was kind of my arc. And it turned out that what I was doing for those businesses was helping them with the finance for their sales and marketing efforts, right? And you think about finance as a business and profit, translates pretty quickly to investing, and that's kind of how I made the jump.
Okay. Now, that's an interesting thing, because you've seen the inside of companies that you're looking at from the other side. It's always good to see things that way, and be able to translate that stuff into plain English, which is also a benefit. Now, I occasionally have had the pleasure or misfortune of stumbling over colleagues in the workplace who, when they decided to take a intellect break during the day, during the morning, and they day traded. They'd jump with their favorite chart and they'd go, okay, things are moving up and down, no, but like, someone's libido at any point in time, up and down, and they'd trade while they were at the office. No names, no pack drill, which is what they did. And I often wondered what the hell that practice did to the value of anything, because it looked as if what they were doing was essentially engaging in the behavior that somebody dealing with a computer game on their iPhone like Candy Crush. It appeared to me that they were playing a game, but they weren't doing something else. Am I right?
Yeah, the stats are pretty clear, mate. I have not seen a single survey or study suggesting that day traders lose money less than about 85 to 90%. In other words, go broke, right? So the analysis done by the researchers says that somewhere between 17 and 20 and 9 out of 10 of actually go flat broke. And the reason is, well, firstly, investing is a positive expected outcome game, right? The market grows, the economy grows, profits grow over the long term. And you've already kind of talked about that's the focus of this conversation. In the short term, I'm trying to outtrade you in a zero-sum game. Will the shares of Woolies go up today or down today? Will the market go up or down today? Will the Commonwealth Bank go up by lunchtime? Will I try and make a couple of percent or a couple of cents trading something that I'm going to buy this morning and sell this afternoon? Hence the day trading idea. You're trading inside a day. And you're literally gambling on where a price might move next. It is closer to a horse race than it is to sensible, sustainable investing. In fact, I've made the case many times. Once you have your trades have to go through a stockbroker, it adds that veneer of respectability. You throw the guy's got a suit on, he's in a glass office on, Bridge Street in Sydney or Collins Street in Melbourne, and all of a sudden it becomes, quote, respectable, right? I'm not gambling, I'm investing. The reality is that sort of stuff should be done through the TAB, not through the stock market, because it is literally just speculating on what might change. Does which fly crawls up the wall fastest, rather than investing, which is taking a ownership stake in a business for the long term.
Can we use the term speculation?
Mm-hmm.
How do we define it for people out there for whom the language of investment may as well be Swahili?
Yeah, nice. Thank you, mate. That's a good point. So look, there is no definite definition, right? I can't define it in a way that's going to please everybody. What it's best done is it's best done in contrast to investing. So I'll start with that and work backwards. To invest is to put money aside today with the hope of more at some point in the future. And implicit in that assumption, or implicit in that description, is the long-term future. The future isn't tomorrow, not next week, next month, not even next year. I'm talking years and years and decades down the track. That is investing to put some money aside now for a greater return meaningfully down the track. Speculating then is to effectively engage in the same conduct, which is buying or selling shares on the stock market. Speculating can be broader, right? But in the context of investing, hoping that in the short term, I manage to guess which way an asset price might go. And so that's the difference effectively is one of time frame. Speculating is short term. It's not based on the business's performance. It's based on where the share price might go next. I've got a 3-letter code on the ASX. I buy shares, I sell them later today, hopefully for a profit. That's a speculation. If I instead say, and this I don't own these shares, it's not a recommendation, I think Woolworths will sell more baked beans in 5 years' time in more retail stores to more people and keep their costs under control such that they will make more money. And therefore, if I buy at a sensible price today, I get a positive return. That's investing. Now, that feels like it's harder, and it is. Thing is, over time, it's more profitable. We know from history that it is far, far more profitable to invest for the long term than to try and day trade or speculate. And the reality is, Tom, we can actually say speculating is gambling. It's the same thing. Again, it has this veneer of some degree of respectability saying, I'm not gambling, I'm speculating. You're doing exactly the same thing.
Okay, so they may as well go to Grand Casino and go to one of those
just about
electronic game machines, or go to the track, or buy those in-app things that you buy for the little games when you're stuck in the hamster wheel wanting to get past level 59.
And by the way, Tom, just quickly, it's the same impulse. It is literally serving the same impulse, which is the dopamine hit, the gamble, the fun, the excitement, the adrenaline. There's much, much more in common with Candy Crush and day trading than there is with day trading and investing. Yes, it's on the same market. Yes, it's using the same financial instruments, the same shares, but the conduct is far more like putting $5 on $50 on the table at Crown, or paying $5 to play an online poker or something else. That's far more similar to speculating than speculating is to investing.
Okay. Now, having said that, there are times when things go wrong.
Yes.
Financial institutions do the wrong thing. Companies that are meant to be energy companies and then do all sorts of funky stuff like Enron
Yep.
turn upside down, or there are behavioural and governance issues.
Correct.
Those sometimes cause people to rush for the exit. Is that in substance the same kind of behaviour we're talking about when we talk about the day trader that simply wants to get their, jollies out of throwing money around?
I don't think so, mate. And I think where it's different is if you bought shares in Enron, well, it depends on your motivation and your activities, right? If you bought Enron shares to try and double your money tomorrow, then yes, it's exactly the same. If you bought Enron shares because someone told you, look, this energy trading company, this is going to be great. And in 15 years' time, this is going to be the biggest company on Wall Street because it's going to do X, Y, Z. And you kind of go, oh, that sounds real. I'll buy my shares. And then at some point, as it gets more and more and more, you think, wow, I'm getting rich. And then the share price falls. And you have no intention of responding that way. But human nature responds to fear. We know, we feel the pain of loss 2 to 3 times as strongly as the gain, as the joy of an equivalent gain. So as soon as we start to see volatility in the market, whether it's Enron, which is a straight out fraud, whether it was another company which simply went down a bit because whatever happened, or because the whole market, like during COVID in the early 2020s, March, April 2020, when the market crashed 38% in 6 weeks, people kind of went, this is no fun. I didn't buy this to lose money. What the hell am I doing in shares? This is stupid. I'm out. They just let the fear, the emotion, the reality of loss, paper loss, but loss nonetheless, overtake their brains and cause them to do things that most sound financial advisors would say you should not do.
How do we think about it differently?
So you start by understanding what it is you're trying to do and the result you aim to achieve. And then you cover that with some real world understanding, knowledge, acceptance. So if you look at any chart of the ASX or the US S&P 500 index, just one of those, it's an aggregation of 500 US companies, the biggest ones, and you look at the journey over time, what you will see is a chart that goes up, down, up, down, up, down, up, down, up, down. But as you zoom out to longer and longer time frames, the squiggles get smaller and the line goes up and to the right. And so the lesson there has been, at least historically, I'm not allowed to make promises about the future. If you owned a quality portfolio, so quality companies, if you're diversified, people say to me, I've got all 4 banks, so I'm diversified. And I say, no, that's not diversification. You have a range of companies across a range of industries. You have enough of them, and not one of them. If anyone goes broke, your portfolio is still okay. If you add to that portfolio regularly to take advantage of market fluctuations, and if you tell yourself, I'm in this for 5, 10, 20, 40 years, and I know during that time, there will be a couple of GFCs, a couple of COVID crashes, a couple of geopolitical events, terrorisms, or whatever else it is, and sometimes the market will really go nuts. But over time, I know that history tells me that the long-term investor has done extraordinarily well by staying invested. That's the lesson. I'm going to put a number on this, Tom, and I'll let you jump back in. Over 30 years, Vanguard's a fund manager, a not-for-profit fund manager based out of the US. They work here as well. I have no affiliation with them. They publish a chart every year. The last time they published the chart was the middle of last year, showing that over the previous 30 years, now think about what happened over the last 30 years. Think about all the wars, terrorism, pandemics, global financial crises, everything else that happened over 30 years.
Yep.
During that period of time, 10 grand invested in 1994 was worth $130,000 30 years later, and you had to do precisely nothing. You didn't have to add money. You didn't have to touch it. You didn't have to trade it. You didn't have to change it. You got a 13-fold return by putting money in the bank, or in the share market in this case, and sitting on your backside and leaving well enough alone. That is the fundamental lesson of long-term investing.
You will deal with people who freak out from time to time.
Yes, a lot. And that's fair. It's human nature, mate.
I don't doubt it. And human nature doesn't change. do you ever discuss with people how to adjust their thinking when things start to get bad? Because we do have a, fight and flight type instinct as humans, right? And that can sort of lead us to anticipate danger if we're crossing the road. We're seeing the semi-trailer coming and we're slightly in the way of it.
Yep.
Or there are other things that give us a similar impact. For example, I may be losing 50 grand because the company's blah, blah, dropping rapidly down the share market. Is there any psychological strategy or the way of thinking about this stuff that you walk people through? Because it can be difficult to detach yourself from media coverage that is generally sensational when stuff goes bad.
Yep.
Makes the bad stuff the first paragraph or the lead every time, and the entire vibe is negative. How do you cope with that?
The stereotypical example, Tom, is when you pick up the paper or log on these days and it says 48 billion wiped off share market. And they never really contextualize that. Is 48 billion a lot? Well, it's a lot of money for you and me, but is it a lot of money relative to the size of the share market? Nah, the answer is who cares? 48 billion is a big number and you might be scared if you read the article, so you better click and read. And that's journalists, that's newspapers, right? That is what it is. But you're right to ask the question. The answer is a couple of things I've talked about already. So firstly, understanding the game you're playing. So really, genuinely, we make stock recommendations all the time. I say buy shares in company X, right? But I also say to people, if you want to follow me and trust me and just follow exactly what I say, go for it. But if you're not going to commit to that, don't do anything until you know why you're doing it. In other words, if I say buy Woolies, if you're going to follow it and listen to me no matter what, that's fine. If you're going to make your own judgment at some future point, you need to make sure you understand why I'm recommending Woolies and agreeing with that, so that if trouble strikes, you say to yourself, no, I remember why I was buying Woolies. I bought Woolies because I expect that in 5 or 10 years' time, they're selling more baked beans to more customers in more locations and making more profit. And so it's the end goal. It's the eyes on the horizon. That is the trick, right? So it's know what you own and why you own it. The other thing is the history I just talked about. So look back, and there's some Vanguard do a great chart, mate. It's the Vanguard index chart if people want to Google it. And you'll see this line, and you see that 130 grand over time. They actually highlight nicely on each in different points in time. This was the GFC. This was the COVID crash. This was the 9/11 terrorist attacks. This was the Bali bombings. And what you get the sense of is, yes, the market might have squiggled at that point, but looking back, those daily freak out squiggles are almost hard to find. They're almost hard to see because in the context of the longer term, they fade away. And so it's really coming down to the answer is not when it happens, what will you then choose to do? It's before it happens, think about when it happens, and what will you hope you will do at that point. In other words, take the emotion out of it. I show them the chart and say, if the market falls 15% tomorrow, you should still do nothing, right? Because here's what happens. The GFC, big fall, COVID crash, 38%, right? To almost $2.05, dropped off your portfolio in 6 weeks. Freaky as hell, right? I went through, I'm like, oh God, this is awful. This is terrible. This feels awful. But what did I do? Yeah. I didn't, and successful listing is not the avoidance of that feeling, mate. It's not the avoidance of the freak out. It's to disconnect between your brain and your fingers, logging into the brokerage account saying, sell this, it's ridiculous. And I will say too, there were some very well-known fund managers who sold everything at that point. And they said, I will not invest again until COVID has finished. Well, guess what? COVID's still with us. The pandemic took 2 or 3 years to be declared over, and the market rallied massively over that period of time. So people owned at the top, they sold at the bottom, and then as the market climbed back up, they said, I'm not getting back in, I'm going to wait. And so waiting for certainty is always going to cost you money. So know what you're doing, know what you own and why you own it, have a long-term perspective such that you know as things grow, they will fall back sometimes. That's normal. That's what happens. In fact, the market falls 10% about every 13 months. It's the exception, not the rule. So it's the rule, not the exception, right? This is what happens over time. So get used to that. That's kind of the important thing. If you're thinking about your investing approach, lock those things in your head, decide those in advance so you know how you'll respond. The last one, mate, is don't celebrate your wins too much. And that sounds counterintuitive. But if you start to judge your own investing success by, Qantas is up 1% today. Coles are down 2% tomorrow. Once you get in that daily thing, you mentioned day trading at the beginning. Once you start to think like that, you obsess over the 6, max over 6 hours a day. You obsess over 6-hour moves.
Yeah.
If you step back and go, well, if I celebrate the wins, I create in myself the expectation of looking regularly, of using that short-term dopamine or adrenaline or both hits to make myself feel good. Instead, you sit back and go, it doesn't matter to me what my portfolio does this year. Now, that sounds weird, right? When I go on holidays, I've been away for 3 weeks at a time. I just leave my portfolio where it is. People say, might the companies fall? Yeah, they might. They might go up as well. But I'm not in it for 3 weeks. If I liked the companies 3 weeks ago and I'm owning them with a 5, 10, 15-year time horizon, why do I care what happens in 3 weeks? And again, I'm not saying it comes naturally. It doesn't. You have to learn it. But when you can really do that for yourself, you set yourself up so that when you get to the next event, you're not already in that mindset of, oh my God, what do I do? You're in the mindset of, that really sucks, but I kind of knew it was going to happen, and I know I'm going to stay the course.
Now, I might segue into something and be uncharacteristically inconvenienced here.
Go for it, please do.
That all sounds sound from a thought process point of view.
There's a butt coming, isn't there, Tom?
I'm not sure how big the butt is.
Go on.
But yes. Why is it that we can't get that same psychological mindset when we come to the political environment, when it comes to policy development?
Yeah, I think for the same reasons, with a twist. I think we have learned. I'll be relatively forthright and probably not surprising. Won't insult too many people. I think our politicians have ceased to deserve our trust as much as they used to, and so we've learned not to trust them, and we've learned as a result to take what's in front of us, grab the bickies now, because the plate might be taken away later. And I think that is a very reasonable thing for most people to think, because we've been trained by experience to think that way. And it's chicken and egg. We can only think long-term and afford to think long-term and trust the long-term if we have a counterparty in parliaments around the country who will take that faith and say, I will repay that faith. I will do what you want me to do, which is set the country up, the state up, the territory up, so that in 5, 10, 15, and 20 years' time, when your kids are here and you're not, the country will be better off. And I think 85% of people would say, I will take some pain now if I can have gain for me or myself or my kids later. But then they say, but hang on, who's doing that? I've had people on social media, even just today, who say, well, this tax idea sounds good, but they're probably going to waste it, so I'm going to say no. And I say, but if you knew they weren't going to waste it, would you think that was a good idea? Oh yeah, I'd be in favor of it. But they're not prepared to go the extra mile and say, I will trust that my money or my vote will be used appropriately, because it is being, I've learned from experience that that's a bad idea.
Yeah.
Now that's the cynical part of the answer. The other part of the answer is exactly the same as investing, which is a straight up, we're not born for it. I say regularly, investing well is a successful dampening down, so quarantining, putting aside of our biological advancements, right? We have learned over millennia from the savannas of Africa through to today to, as you say, when you see the semi-trailer, when you hear the lion, when you see the lightning, you write, what can you put aside for tomorrow? What can you possibly put aside for 50 years' time that is going to be worth doing? And biologically, we suck at that, right? Because we don't have any precedent for that. Pre-industrial revolution, the best we do is store some grain for a little while, all right? Maybe hoard some gold for a bit. The new opportunities, both in investing and governance and running a country and a society as complex as a Western democracy like Australia, requires of us a faith in the future, an understanding of the future, and a belief that those people we empower will do the right thing for those periods of time. So I think if we could trust our politicians more, and we can take that investing approach and say, if I stop this now, if I don't want it right now, but I say, don't give me the tax cut, build the infrastructure, build the bridge I can use in 50 years' time, that instinctively makes sense to all of us. Why we all build our own houses, right? We live in bark huts if we didn't think the house was going to last for 50 years. But we put the investment in a very real, very tangible sense for that long term. So we know what it's like to do that. We do it every day. You don't buy a car that's going to crash tomorrow. You buy a car that hopefully will last you, based on how much you're paying for it, a number of years. So we get the concept, but I think when we don't really understand the trade-off and biologically don't get it as deeply as we should, we take the shortcut and go, you know what? Bird in the hand, two in the bush. I'll take the bird in the hand.
What does it do when people say to individuals, are you better off today than you were 2.5 years ago or 4 years ago, right?
Yeah.
What does that do, given what we've spoken about in terms of psychology, given what we've spoken about in terms of long-term thinking, what does that do realistically from your perspective?
Oh, it destroys you. I mean, we see it in investing. If the last 2.5 years were good in investing, people will throw their money at anything with legs, right? They will invest everything in everything, and prices go up, stocks go up. I want to be part of it. FOMO, baby, let's get on with it. The reverse is also true in the stock market. So we had post kind of COVID, there's lots of money around, people throwing money around, and the market was at a low and started to climb. We've had one of the least interested bull markets that I can remember in my career just recently. In fact, we hit some record highs late last year, and almost nobody was celebrating. Why? Because it wasn't being talked about. It wasn't, it wasn't by the time that is, by the way, then it'll be too late because we're already at the top, and there'll be another cycle, another leg down. So I think you think about that. Are you better off than you were 2.5 years ago? We extrapolate. Humans, again, it's biology, right? We can't make every decision from scratch every single minute of the day. We extrapolate from the past. Last time I was here, this happened. I'll watch out for this thing again. There were lions here yesterday. I'm going to watch out for lions today. I made money in the stock market yesterday. I'm going to watch out for I'm going to make money today. The risk of and this is investing 101 and behavioral finance. I won't get too deep into it. We confuse causation with correlation. Are you better off or worse off than 2.5 years ago is not the right question. It suits politicians who want to take government from opposition, or governments who want to stay in government if it's been a good 2.5 years. And both parties use it, right? This is why it's neither will call it out because they want to use it next time, or they used it last time. Causation is not correlation. I said Jim Chalmers done it. I'm not going to be political. I'm fearlessly bipartisan or non-partisan. Jim Chalmers put out a tweet a week or so ago, and basically said, hey, during Labor, this has happened, that's happened, that's happened. And it was all hogwash. 3/4 of it was during Labor's reign, inflation's come down. So that's absolutely true. He's 100% right. He allows us to infer, or invites us to infer, Labor fixed inflation for me. To which I replied on Twitter, really, did he fix the US inflation as well? Because that's impressive. If Jim Chalmers has fixed US inflation, UK inflation, EU inflation, that's wonderful. Now, by the same token, they're not responsible for the bad stuff either. And so what I say to people is look at the policies and say, what results came from the specific decisions or actions? That's what you need to event. Now, that's complex, right? It's hard. You got to think about it. And most people just don't want to think, inflation's up. I'm going to blame Labor. Or inflation's come down since. That's Labor doing a great job. Neither is true. Labor didn't create the inflation. Labor didn't fix the inflation. Now, they could have done more to fix it. They could have done more to make sure it wasn't as bad as it got to. Sure, that's true. They also could have done less. But fundamentally, it's causation you need to look for in life in general, certainly in investing, rather than pure correlation. There's a great Simpsons episode. You know the one with the tiger and the rock? Lisa picks up the rock and says to Homer, I have this rock. I haven't seen a tiger since I've had this rock. And Homer goes, that's amazing. I want to buy your rock. Now, the rock didn't keep the tiger away. It just happened to be correlated. There was a rock there. There was no tigers. Again, stupid example, except that's exactly what we all do. I'm not criticizing anyone. It's human nature again. We correlate. It's what we do. You can't afford to causally work out, are you sure that's a lion? Is it really going to eat me? Is he really that hungry? Can I run faster than that lion? You're out of there as soon as it happens, right? As soon as the roar goes, you're like, I'm not hanging around. So it's human nature. We're not criticizing anybody for doing it, but we improve our lives and our society when we think a little more deeply and a little more causally about what's happening around us.
You've said a lot that's going to be instructive to many people. But let's explore one more thing before we wrap this up.
Sure.
One of the areas of policy that is consistently challenging and extremely difficult to do anything with possibly because of many of the things we've spoken about, is taxation.
Mm-hmm.
Why, in your view, can't we get substantive tax reform in this country at the present time?
Two things. The longer term one is political opportunism. We know that it's easy to create. I mentioned fear and gain earlier, right? The fear tactics work, and they work. We kind of know that they work. The science tells us that we feel the fear 2 or 3 times as strongly. So that idea of like, I want to avoid that possible downside, even if the upside is the same size, we'll take the avoidance of downside rather than the chasing the upside. So that's just human nature. That's what we do. So that's the really big one, and that happens, of course, across all parties, all circumstances. They're the bad guy. They're going to wreck your lives. Don't vote for them. Vote for me. I'm sweetness and light. Negative campaigning has always worked, will always work, and it's an absolute stain on our polity. But our politicians aren't, frankly, what's the right word? Aren't reasonable enough, aren't respectful enough, don't act with enough integrity, frankly, to do the right thing and say, I will. New South Wales state government, by the way, the last election was great. Chris Minns and Dominic Perrottet as their respective leaders. If you're in New South Wales, you know them. They ran a very respectful, very positive campaign, and it was brilliant. So huge props to both men, opposite parties, I don't care. Did a great job. Most of it is just political negative rubbish, and we know that. So that's why can't we have tax reform? Because when someone suggests something, now the second thing, as I'm about to get to, someone's just going to lose. We have learned and been told and been taught and demanded that whatever you do, no one must lose. There can be no losers from this policy, or we won't vote for it. Right? We've put the personal ahead of the communal, ahead of the societal, and ahead of the long term. And so we say, if I lose from this, I'm not voting for it. Now, on one hand, that's really natural, really rational, right? I'm not going to vote for a tax increase on me, except I would personally, because I have argued strongly against stage 3 tax cuts under both governments, and I benefited from stage 3, right? We should not have had them. Different topic, I won't get into it. But until we say what's good for the country, literally John Kennedy, right? What can you do for the country? Not what can the country do for you? That's how we do it. The last one, mate, is, and this is new or newer, I think that reform is harder now because we have a more precarious financial circumstance in society. There are more people who have, for a combination of earnings power, frankly, debt, obligations, cars, private schools, TVs, mortgages. Everything is so precarious now. My ability to be generous tends to come down to my ability to absorb whatever changes might happen. Okay. If I feel precarious, if I'm not, if I feel like, oh my God, I might be worse off, and therefore I might lose my job, lose my house, lose my car, have to pull the kids out of school, then I feel like I can't afford to be generous. Right? I've got to worry about me because no one else will. And so that precariousness actually makes us more selfish, in my view.
Which probably means we're in for an interesting election period as we head into one in terms of any policy that even goes near taxation. We saw that over the weekend with the announcement of the FBT. Mm-hmm. The FBT concession or exemption for businesses earning less than $10 million, up to $20,000 for entertainment. Mm-hmm. What nobody has spoken about is the fact that the accountants I know have said FBT is the worst complied with tax law that at the lower end of town. People don't do it properly. So giving them an exemption for something they don't do properly probably means a decrease in compliance costs, probably encourages people to actually spend a bit of money out and about the place in outlets nearby and whatever have you. Wherever they go, I'm not fussed. But it's interesting that one of the things that isn't mentioned in discourse on that policy is the fact that there will be people for whom it might actually ease tax compliance because they won't have to worry about FBT up to a threshold of $20,000 when it comes to food and entertainment. It's interesting.
It is. And by the way, you mentioned tax. The government's already ruled out negative gearing and capital gains tax reviews as part of, this ruling out thing of, oh my God, I might scare the horses. The last thing probably I didn't say is focus groups, right? We all know that. And it's the bane of any serious policy watcher. When you are given daily, weekly feedback on what I just said on, Kyle and Jackie O, or, Albo's on there singing songs and doing whatever he's doing, and he gets feedback immediately about what people think about the policy. there is zero ability or willingness. It's actually willingness and a little bit of ability to actually frame up the picture. And frankly, it is the V word, the vision word, as Paul Keating famously said. What do you want the country to be like? For all of their failings, and there were many on both sides, John Howard and Bob Hawke were probably, maybe Paul Keating, were the last of our conviction politicians in modern Australian political leadership, because the rest of them just got to the top by climbing the greasy pole and then asked the polls what they thought and the focus groups what to do. And whenever you do that, you lose the opportunity to reform, which is doing something different to what people already know and want and do, and building that case. And that's, I mean, why can't you do that for all the other reasons I just talked about, by the way? But fundamentally, we won't get change until somebody says, I have a vision, I have a conviction, I have a view, and I will take you with me, and I will convince you of the case, or I will lose trying, because I think this is the right thing for the country.
Scott, we've covered a lot in around about 35, 36 minutes, and we've probably bamboozled some people along the way. If people want to know more about the Motley Fool, where do they go?
Mate, you're very kind. Fool.com.au. Lots of articles there. We've probably seen some marketing stuff. If you sign up to the newsletters, just be warned about that one. I want to say that up front. I'm on socials all over the joint too. So if you want the some me without the marketing, feel free to do that as well. It's been lots and lots of fun. Thanks for the chat.
Thank you. Now, that's it for Ravlic at Large for this episode. There'll be a heck of a lot more episodes coming and flowing through in the coming weeks and months. So thank you for joining me. Stay safe, look after each other, and there'll be another episode on this channel.